Welcome to another sunny afternoon in West Michigan. April 16th, the Market Update Desk with Scott Riley, brought to you by Mortgage One. Bonds today are continuing their move into the red direction. We're hitting some more resistance. The 10-year bond is closing in on 4.66. We see this morning. We're hoping that kind of has peaked out where we can get some retreat from it, hopefully. One thing that may help us out this afternoon at 1:15, Chairman Powell speaks. Hopefully he can give some words of direction of where the Fed is going to go and start to calm the market from where we've seen this run up over the last week and a half. CoreLogic came out and released their rental report for the month of February. It's actually a little surprising. It showed that rent prices are up 3.4% year over year, which is a pretty big increase from the previous one we had of 2.6%. In fact, it's the highest year over year increase we've had in about the last 10 months. Now, on the positive note, we got some builder confidence data today. The National Association of Home Builders Market Index showed that the index that builders are showing for current sales was up 1 point to 57. It's actually an expansion territory. Future expectations, kind of giving us a glimpse of what they're seeing in the future. It did fall 2 points, but it's still at an index rating of 60, which is still in that important expansion category. Buyer traffic rose 1 point to 35. Well, that is in contraction territory. It's the highest level since last August. So overall, this was a positive report that the builders gave us. Some of that new buyer traffic slowdown obviously is where rates have increased a little bit. Now on housing starts permits, which is very important data that needs to be out there. Housing starts fell almost 15% in March after we did show a very nice gain in February. The annualized pace fell from 1.55 million units to 1.32 million units. Starts are now down 4.3% year over year. And single family starts, which is the most important component of that, did fall 12.4% to an annualized rate of 1.02 million. There were just 299,000 multifamily starts last month, which is the lowest since 2017. The reason for that is there's pretty much almost a record multifamily units under construction as we're speaking. 957,000. That's a lot of rentals that are going to come on the market, probably anywhere in the next 3 to 15 months. Now, with that abundance of options and inventory for renters, we should start to see an easing of those rental pressures that we've been facing, really for the last 3 or 4 years. Building permits, which gives us an eye into the future supply, that fell 4.3% to an annualized rate of 1.46 million. Single family permits fell almost 6% to just under a million units, 0.97 for the annualized pace. Completions fell 13.5% to an annualized rate of 1.47 million. Well, single family, the subcategory, came in at down 10.5% to an annualized rate of 950,000, just under a million. Bottom line, we may see some easing in that rental market because of that abundance of inventory coming on. But home prices, yes, I know they're still high from where we were a year, 2 years, 3 years ago, but there is, as documented from this, not enough inventory coming on the market. And there's a lot of reasons for that. Prices for materials, permitting prices, subcontractor supply of workers to complete these projects. So we don't have enough supply coming on. So that is going to continue this pricing pressure upwards. So if you wait to buy a house, just understand you will be paying more in the future, not less. That's why it's important, regardless of interest rate, that you're out there making offers, trying to get one under contract now versus waiting in the future. That higher price a year from now, if you're going to wait a year, could be, $10,000, $15,000, $20,000 more than what it is now. And yes, the interest rates are probably going to be lower next year. But the difference of a quarter, 3/8% in interest rate is very small compared to what the pricing pressure is going to be a year from now. And also the increased amount of competition that'll be out there when interest rates fall. On a technical basis, what we're seeing in the market, bonds are testing their support at 99.196. And if that particular level doesn't hold, the next stop's all the way down to 98.867. That's a sizable drop. 10-year yields, like I said earlier, are testing that 4.66 level. If that level doesn't hold, the next ceiling in the 10-year bonds 4.734. Little concerned on where these pressures are coming, what we've got going on in the oil aspect, energy aspect of the market. We saw a small retreat in WTI crude oil yesterday, but with everything going on in the Middle East, don't know if that's going to hold. So there's a lot of geopolitical aspects that are going on right now. We'll try to keep you updated on everything. Feel free to give us a call. We can go into more depth on this, and we can help get you pre-approved or to get your offer accepted. Scott Riley, the Market Update Desk, West Michigan's original singular news source for market information for you, our clients and realtor partners. 616-293-2189. Have a great afternoon.